A simple search of stock market on Google will bring up a list of different news articles, and pretty much all of them are extremely bearish. In yesterday's episode, or the day before, we discussed just how bearish sentiment really is. In today's episode, well, we're going to look at some key levels just in case if the S&P 500 or various other indices are going to be heading lower. All signs, as of right now, all the narratives are pointing to yes, it's going lower. But typically, in these situations, you want to take more of a contrarian approach. You're watching the Stock Market Brief Show. Today is a weekly recap. We got a lot to talk about. Let's get into today's show. All right, everybody, welcome back. So I'm bringing up an S&P futures chart to give you kind of just an idea as what to expect going into this next week. So you can see here, indecision type candle, it tagged a lower trend line from here in early February on up, and we tagged that trend line. And I'd say if we start breaking down through that 4,400 area, 4407, which is also in confluence with the 14-week moving average, it could bring us to around this previous low here or this previous low here, which is 4350 to around 4200. However, if we do start breaking above the previous high, which is at 4492, I think that can give us the momentum we need to go tap into right around 4600. Now, there's been a lot of selling pressure, there's been a lot of fear, but take a look here. This is the CBOE 2021 option expiration calendar. Yes, you probably heard that there was triple witching going on or quad witching going on, and that's when all the options are expiring. And if you notice something here, pay attention to the red right here, the 19th, the 16th, 21st, the 18th, the 17th, the 20th, the 16th. What do all those have in common? Well, it's the third Friday of every month. So if you just take a look at the S&P 500 and you just say, okay, what happens typically on the third Friday every month? Well, during option expiration, there's typically more volume, there's more volatility, and we've been seeing it take place recently around previous dips. So we're getting something very similar to take place here as the price action pulled into the lower Bollinger Band and right there at the 50-day moving average closing slightly below it, and we're seeing an uptick in volume. Now, I think that we need more time to pass in order to understand if this is just a volatile moment because of the options, or if this is the start of something bigger. Everybody believes that this is the start of something bigger as of right now, which makes me very hesitant to be bearish, okay? Doesn't mean that I can't flip on a dime, but if you take a look at the S&P 500, we did break down from this technical pattern, and that is very significant. We did so on big volume, but mind you, it was option expiration. So there's still a strong possibility that we come bouncing back. We need to see what takes place Sunday and then into the cash open come Monday. Another thing that I want to point out that I haven't heard really anybody talk about was the RSI. It was trending up, right? We have a low, a higher low, a higher low, a higher low, but we did crack down through 50, came back up, back tested, and now we're heading lower. So that could be the start as it mimics this trend line crack here too as well. It could be the start of something bigger and potentially a correction, but keep in mind, we're not even 3% down from the all-time highs. This is just a subtle pullback, if that's what you want to call it. If the price action continues to fall, well, we're going to look at other key levels to be mindful of. Look at 2.8%. We were down on the week, 2 red weekly candles. Yes, that big uptick in volume. Okay, we closed below the weekly 5 EMA, and we're sitting right at around the 10-week on the SPX chart. And we tagged on the S&P 500 futures the 14-week, which is a widely tracked EMA or moving average there too as well. Okay, so if this does continue to fall, where can we potentially look on this specific chart? Well, I mean, 4350 to 4200, right? That was where we discussed on the futures chart. That also lines up with the 20-week moving average here in the middle of the Bollinger Bands too as well. So that's going to be something to keep an eye on. I don't know if we're going to be getting there next week, unless if some sort of news event takes place. And to be quite frank, that would only bring us down to around, 3-4%, 3.5-4.5% down from the all-time highs. And if you look at the monthly chart, the monthly EMA, the 5 EMA is at 4348. So if you're looking at this at 4300, 43, and that lines up pretty well right with the 20-week moving average. So that's at 4341, and then the 5 EMA is at 4348. So it's right around in that target range of confluence of support on different time frames. Okay, now if you look at the quarterly chart, I mean, we're, completely outside of the Bollinger Bands. All right, so this is historic times, and typically when you get out of these areas, you can see rubber band snapbacks. And, this is obviously a longer term chart. And every time that we've really had a red candle on the quarter, the Federal Reserve really just steps in. So I can see everyone's kind of why people would be saying, like we can see this thing fall over. That makes sense. We're outside of the upper Bollinger Bands, and we've been outside closing for the last 1, 2, 3, could be potentially 4 quarters. So we'll continue to watch that. It is interesting how the upper Bollinger Band acts as a level of support. Now check this out. Where's the 5 EMA? Pretty much spot on to 4,000. So a reconnect to 4,000. If we get some sudden hit to the downside, that's going to be that level to really pay close attention to on those bigger time frames. But if you take a look at the 15-minute time frame, okay, and you take a look at the week trading, what does it look like? It looks like a whole lot of nothing. Okay, it really does. We just chopped around. That's all it was, and we closed almost at the low of the week. And now we're forming what's known as another falling wedge, and a falling wedge can break out. And if we break out, that can take us right back up to the 5-day moving average that is declining to potentially this 447. We were looking at this inverse head and shoulders on the previous episode, this left shoulder, head, right shoulder. And then we said what? We said if it breaks above 447, then that can offer up an opportunity to go higher. Well, we got the gap down and we got followed through to the downside. So the entry for the long position was never taking place. What else do we talk about? Well, short term speaking, okay, it's bearish context, right? The 5-day moving average is still declining, so you need to just be mindful until it starts becoming neutral and price gets above it. Then it'll start, like I said, flattening out and turning up. And if it starts turning up, then it's short-term bullish. Falling wedge taking place. What would be best case scenario? A best case scenario for the S&P 500 would to see some sort of gap down in the futures market where it overextends to the downside, and then we'll probably see potential dip buyers step in. If that's the case, then we might see where we can start breaking above those key levels right around here. So if we get a gap down and then all of a sudden, the bulls start stepping back up, that could be a good sign for the S&P 500 to take place. But going into like the end of this week, the Friday option expiration, it was kind of just all over the place. So I didn't do any significant amount of trading. But falling wedge, like I said, so look for a breakout of this. We'll see what happens on a big gap up. Let's say that takes place, a gap up. Just be hesitant where it gaps up to, if that's the case. If it gaps up to a declining 5-day moving average, I personally wouldn't chase that. Yeah, you can get lucky, but I would like to see price digest or fill that gap and then potentially bounce from those areas. That's what I would like to see if it does gap up. If you take a look at the VIX, if you follow me on Twitter, I talked about this. This is the 30-minute VIX. As we were pulling up to this resistance, I said basically, look for this to be the bottom for the day, and we're pretty much spot on for where it bottomed out for the day. And the reason why I was looking at this as an area of resistance and then matching it up with the S&P 500 is because you can really use the VIX support and resistance levels to potentially target good entry levels in the S&P 500 if you pay attention on these 30-minute time frames. Like, it could get very overextended to one side, and it was. And if it gets overextended to the upside, chances are you can look for long positions. Being that it was option expiration date, I knew that it was going to be more volatile, so I kind of just stayed on the sidelines for the most of the day. But we broke out of this wedge, we came up, we tried to tag this upper area, so this is going to be an area to watch. We'll see what happens coming into, obviously, Monday's cash open. And then we have a falling wedge right here on the weekly time frame, and check this out, it's right there at the upper weekly Bollinger Band. Okay, and the RSI's got back above 50. Bollinger Bands are very compressed. Okay, so when they're compressed, contraction obviously leads to expansion. I keep on harping on that. So this could be the start of a breakout, but it hasn't done it yet. We haven't got a confirmation. So as of right now, this technically could be just a periodic or just something that's happening just right now for this week. And then we might see it sink down, which would technically push the S&P 500 up. So we're at these very interesting points, right? The daily time frame for the S&P 500 broke down from this falling wedge and broke down from the 50-day moving average. You can draw this, like I said, a couple different ways, so it's right in that range. And then you take a look at the weekly VIX, and it's right there at the verge of potentially seeing some sort of breakout take place. All right, so what do you do in situations like this? Well, we'll talk more about that in the conclusion section of like kind of how to prepare and handle, because we could be at a significant turning point, one at which we kind of just all of a sudden pressure back up to the upside, or one of which where this is where we see some more dramatic selling, which sentiment kind of suggests that as of right now. If you take a look at the BP-SPX chart, we're oversold, and oversold conditions can produce bounces. Another thing, it's a positive divergence. A small one, a very tiny positive divergence. We have a low, a higher low, and you have a low and a lower low right here. So the BP chart, positive divergence, that can mark a bounce, okay? Breadth, this is nothing new here. We've been talking about it for a while. S&P 500 percent of stocks above the 50-day moving average is sharply declining. Same with the percent of stocks above the 200. Meanwhile, price is not too far from all-time highs. Now, when this gets down to this 30, 40 kind of range here, it's seen some significant bounces, okay? And then the percent of stocks above the 200-day moving average, this has just been going down really since May. It hit a high in May, which is, really high. 90 reading, and to hold these levels is significantly, that's a big thing. So now it's been just fallen off pretty significantly here, and that's the percent of stocks above the 200-day moving average. So that's nothing new here. It's not much to report because this has been taking place, and eventually a divergence will matter, but we don't know how it's going to matter. So this is really telling me, okay, so the S&P 500 being at all-time highs, and a lot of the stocks within it, the percent of stocks is pretty significant that are dropping off below the 50-day and 200-day, tells me that really it's still the same story. Big tech, the S&P, the Fang Man stocks are the only stocks holding this market up. And what happens if they start falling, if they continue to fall, like we saw this last this last trading week, right? Facebook got hit, Microsoft, Apple, like these big tech stocks, all of a sudden now they're seeing the pullbacks. Okay, so if those things start ripping up, well, guess what's probably going to go up too is the S&P 500. The NYSE advanced decline line also still that divergence there, and you're starting to see, hey, this could be the start of the divergence actually mattering, but we don't know yet, right? Like, yeah, we had a couple, we're down 3% for the week, and like the fear in the market being 3% down it's really honestly mind-boggling. So I don't know how people are positioned. Maybe it's just fear and narratives driving that. Maybe it's just the sentiment coming into the seasonality, where it's typically more bearish. In October, you see, the big market crashes happen in October. We have the debt ceiling stuff coming up, right? So that's also there. We have Evergrande, or how to pronounce it. That's, looks like it's going bust. So there's just all these different narratives, all these things going, and you got to really think like, okay, if everyone's focusing on this and be like, that's what's going to cause the crash, that's what's going to happen. I just don't think that that's going to be the case. I think that if there is going to be a significant stock market crash, it's going to happen where very, very few people are going to be able to call it. And it seems like we're living in a world right now where everyone wants to just predict the next stock market crash. And I honestly think it's Hollywood's fault for that with the Big Short movie. It's almost like everyone wants to be right. But where is money actually flowing? What's actually taking place right now? And yeah, risk is building. That's a given. But where's price? Where's the money flows, right? And price, the best barometer, it's still chugging up, and we're 3% down from the all-time highs. Despite if you're a super bear or a super bull or whatever your case is, you just got to look at a chart. It's not lying to you. It's reality. That's where we are. And one of the biggest things that we're going to have to pay attention to going into next week and following along is the dollar. Obviously, we called this bounce right here, okay? And we said if it bounces from these levels, guess what? It's going to put pressure on the equity markets. It bounced from those levels 2 strong days back to back in the dollar as we're coming back into this trend line. This was forming a bear pennant. I took that off because to this day, obviously, it just blew right past that. But now we're coming into a period of resistance. It really is just going sideways still. So now, like this right here, right? We came into support, we bounced. That brought the S&P 500 down. Now what? We're coming into resistance, and we're coming in very hot, okay? Coming into it hot into this trend line in confluence with this previous area. So what happens if this starts turning down? I personally think if this starts turning down, well, guess what's going to benefit? The S&P 500 is probably going to benefit because of that inverse correlation that we've been watching. and probably commodities as well, because like gold, for example, which I'll talk about on my Sunday movie. I have another sponsor that's supporting my channel, so I'm going to wait till Sunday to post my analysis on gold and silver, and I'll bring in the dollar chart too as well, kind of showing you what I'm seeing. But yeah, if this keeps ripping up and breaks through this 93.50 level, yeah, that can still continue to put pressure on, obviously, on the equity markets. And a lot of people say, well, if the dollar keeps rising, is that going to, honestly, is that going to crash gold? Is that going to crash other materials and so forth? I've seen cases where they rise hand in hand. Okay, we'll talk more about that on the Sunday video. But as it stands right now, when I look at the correlation between the dollar and the S&P 500, right, this peak right here, this area of resistance, brought the S&P 500 up when this fell. Okay, when we acted as support right here, we acted as resistance right here. That bounced, this fell. So now I'm looking where the dollar might hit into an area of resistance, and it literally is coming up to this trend line. It acted as support, could act as resistance, and if you like horizontal lines of support and resistance, well, we're coming into a zone right there too. That's in confluence with it, okay? Weekly time frame, this is more bullish, right? Inverse head and shoulder, we broke out, had that resistance, we back tested, now we're floating right around this area. Many people are calling for the dollar to drop, but I tell you, the longer term charts, they're looking like the dollar wants to get stronger. And that will crunch just a bunch of other people's theses and narratives if we get a dollar that just all of a sudden spikes up out of nowhere. And that could be potentially what we're seeing unfold here, where it sets up for a big news event, right? And that news event, then people will be like, oh, it's because of this and that's why. But price action, if you follow it, right? Look at the monthly time frame. Bullish crossover here. The last time it happened, the last time, what took place? A dollar spiked higher, spiked higher, spiked higher, spiked higher, spiked higher. This is a long-term chart. We're right below the 20 monthly moving average, and we're right above an inclining 5-month moving average. So the month isn't over. We still have plenty of time left. This could completely turn into a red candle, right? It could. But as it stands right now, it's not doing that. Okay, we're pinched between two moving averages. And then we had the bullish crossover take place. It's still below zero, but what does that mean? Well, what if that means all of a sudden we get, okay, some event, some news event, okay, that maybe some news event takes place. This looks like the market's preparing for some sort of news event, and then all of a sudden we get a dollar spike up to this previous support that acts as resistance. So then we get a spike up to like 98, 96, 98. Yeah, guess what? That would probably be strong enough to, one, just rock the commodity world, and then also the equity markets could fall significantly from that point too, and maybe we do see our 10% correction at that point. You know, it's anybody's guess. It's a very, very interesting area, as we've already stated. I'll go into that in the conclusion. IWM, this finished stronger than most of them on Friday, slightly up on the day. We're still in the middle of the range though, and it looks like it wants to try to break out of this little bull flag. And you know, this is where I'd be looking to start hedging long, is potentially the IWM, right? The 200-day moving average is inclining. This is a period. This could be accumulation, or this could be distribution. And I tell you what, it's very significant because of the fact of how long it's been in this area. So whether it's accumulating, which means big institutions are accumulating mass amounts through this 5-6 month channel, or it's going through a period of distribution. Because you got to wonder, say if institutions are distributing, so they're getting out of positions here in this 6 month span. Do you think that if it breaks down and just falls to 200, they're just going to want to buy back in? Not if it took 6 months to get out. No. Right? There could be much more of a significant move, and the length at which that this has been consolidating signals that when it breaks out, either to the upside or the downside, it's going to be significant. Okay? So, yeah, can we see a false breakout and then a rip, or a false bust breakout there and then, yeah, and come back in? Obviously, those things can happen, but everybody is looking at this, and breadth is still deteriorating. If you're looking right at the S&P 500, or you're looking at the NASDAQ and the percent of stocks above, in order for this to like start ripping up higher, we need to see breadth enter back into the market. We need to see the advanced decline line start moving back up and breaking out and breaking those divergences. So as it stands right now, yeah, I would love to see this go to the upside, because I've been positioning more long than anything, but we're not anywhere that we haven't been anywhere, right? So it's just complacency out there in the markets as I see it. People, it's just chopping back and forth, range trading. So it's just something that we got to be just very mindful of, right? The PPO is above zero right now, and it looks like it's trying to curl itself over, which could lend a hand to potentially momentum continuing to break out to the upside. You can see the Bollinger Bands both curling in and then curling up right here, which means it's contracting, and those contractions, once they get contracted pretty tightly, can lead to levels of expansion. If you look at the 15-minute time frame, here the inverse actually head and shoulder is still forming, and this could be potentially flagging right here. And the PMO is starting to cross over. That's bullish. So this is going to be an interesting going into Monday. I think a lot of eyes should be on the IWM, especially if you're looking for long positions. But you can see here the declining moving average is trying to flatten out here and become neutral. It's still bearish, right? It's still bearish, right? High, lower, high, but it's starting to flatten out. And if it starts turning up, that could lend a hand to the IWM small caps to turn up. And if that's the case, well, guess what we are seeing? This last week's performance, guess who was up at the top 3 sectors? Energy was at one of the top 3 sectors, and financials. And guess what? That's a big component of the Russell 2000. So if energy starts ripping higher, if financials start going, guess what's going to be a beneficiary? Small caps, IWM. Okay, so be focused on that. All right, everybody, that is all that I have for you on this weekly recap. I know I could have gone into a significant amount more, but I hope I pointed out a few things, right? We are at a turning point in the markets. What do I mean by that? Well, it's one, everyone's very, very bared up. There's so much fear, and that doesn't mean that they're actually positioning to be bearish. Okay, that does not mean that, because we're looking at surveys, right? The AAII. It means that's what they're saying, but that doesn't mean what they're necessarily doing. And when we look at what asset managers are doing, and we look at the RIDEX, it's still bulled up, in my opinion. Okay? So if that has to flip on a dime, then we could see that move down. So we looked at some key levels on the S&P 500 if we continue to break down. All right, we're only down 3% from the all-time highs. We closed below the 50-day moving average, okay? But it was done so on option expiration. And typically on these option expirations, we do see more volatility. We do see more volume. We do see roll-off. We just see a lot of volatility. And that's what we saw. So it needs to be confirmed going into next week. It needs to be confirmed. So this is not personally a time to panic. This is a time to prepare. And when you want to prepare, you look at key levels. So you look at the S&P 500, US 500. If we start breaking above the high of that candle, cool. I think we target 4,600. If we start breaking below, then I would say 4,200 to 4,350, right around in that range. And we'll talk about that if it happens and when it happens, okay? That's all I got for you in today's episode, everybody. See ya.